and we're good.
All right, welcome everyone to our Facebook Live again. Thank you for everyone that has jumped onto the call. As you guys know, today's April 30th. I'm just going to go through some quick introductions for the three guys that we have here again today. First off, we're going to go with Sean Todd with the lovely beard.
Thanks, buddy.
That's perfect. Second, we're going to go with Corey Butler.
Good afternoon.
How you doing today, Corey?
Great.
Excellent. And our multi-skilled man who not only does investments, but honey and now birdhouses, Brian P. Adams. How are we doing today?
Wonderful, Ben. Thanks.
Excellent. I just wanted to give you that extra plug today. So guys, what we're going to talk about today is a little different than how we've been kind of just doing the market update. We want to talk about the 10 things that make a difference in investing. How does that sound to you guys?
Sounds perfect. Yeah, great
Awesome.
topic.
Perfect. I'm going to hop into the first one right away. What does it mean to be humble as an investor?
I think as we know, like being humble is you don't need to know everything. You don't need to rest on your laurels per se, that it's okay to need help. It's okay to need advice. Some of the most brilliant minds in the world don't figure things out on their own. That'd be my 2 cents on it.
Yeah, I think that's 100% true. I think sometimes people, especially when there's a couple involved or more than one person, I think sometimes it's easy to get to not want to admit you don't know enough, or you've made mistakes in the past. And I think you just have to really sit down and be humble enough to know how to fix a problem or achieve a goal.
I think you're right, John, and nobody can be an expert on everything. Everybody has their field that they're good at and those that they're not good at. And the stats prove it. They say that investors who have advice, that they perform better with their funds, they do better going forward in terms of retirement.
I think the argument could be had as to the old analogy, whether the husband would pull the map out of the glove box or whether they would pull over somewhere and ask for guidance.
That's actually a pretty good tie-in, Corey, because the next step 2 for us, or the next one, is going to be accepting uncertainty for high returns. How does someone pull over to the side, or do they keep going? How would you guys manage that expectation?
I think risk versus return is a concept that's hard for some clients to understand, some investors to understand. And it's actually very simple. It just simply means that, if you want to have the big returns, then you're going to have to accept a little bit of risk. And, the theory is the more risk that you accept, the higher the returns. It doesn't always work out that way, though. And you have to remember that, you're bound by what your time horizon is, or where you are in your life cycle in terms of how much risk you really want to introduce to your portfolio.
And I think also as people, if you wanted something guaranteed, as in, a GIC, well, that's going to offer a much lower rate of return because you're getting a guaranteed return on your money. And so as you move along on the risk scale, then that's where, things don't become guaranteed anymore. And so you have to embrace a little bit of that uncertainty to achieve your goals.
I agree, and I think a lot of people lose sight of that risk reward paradigm, and they think that they can have security and they can make a lot of money at the same time. And as we know, it's not the case. So you really have to decide: do you want security, and we're going to give up something for that security, or are you okay, foregoing some of that security so that you can achieve more? And depending on what your goals are, what you're wanting to achieve, are you buying a cottage in 2 years' time? Are you retiring in 15 years? Are you just trying to preserve some capital for emergency purposes? And that, because those all have different objectives and risk profiles.
100%. And how would a rookie investor know their time horizon?
Well, if you're a young guy like me, Ben, you don't have to worry about that. You got all the time in the world. But seriously, you know, it's important to understand that as we get closer to retirement and the need for income, that we back off a little bit on that risk. And so, you know, as we go through that time horizon, in other words, from age 20 to your 60s or 70s or even your 80s, that it's important to realize that the amount of risk or equities in your portfolio needs to decrease. It can't be, you can't be the same investor you were when you were a 20-something.
Yeah, I totally agree. And I just want to shout out because we've got a whole bunch of people starting to join here. So if anybody has questions, feel free to join in anytime and just punch your questions up on your screen there. We'd be happy to answer. Going back to this question about your time horizon, I think we end up really just having to be honest about, you know, what's this for? If it's buying a boat in a year's time, then of course it's a shorter time horizon. And if you're going to be taking money over a long period of time, then we quite possibly could have a very long time horizon. A lot of people seem to think that the retirement date is their time horizon. That may be true as far as when we first need to draw the first piece of income, but there's a possibility we're going to draw that income for a 25-year period after that. So that can potentially make this a very long time scale.
And I think with time horizon right now, you know, especially during this period of COVID-19 and the market volatility and all the chaos that has happened, it really starts to put the spotlight on, okay, well, what is my time horizon? If I need my money next year, you know, is my portfolio or my savings position that they're not going to be impacted by the market? You know, if I have 20 years to go, is it that, you know, important right now that you need to make a bunch of changes within your portfolio if things were working prior? Probably not. So it really and so that's where this time horizon conversation, it really does tie into your risk. And so they both kind of move in tandem, because as your risk goes down, that generally goes down with time horizon. And so that's something that we try to position with clients throughout their portfolios.
Yeah, and what I've found with regard to when you're sitting down with someone who's, you know, reached that point in their life where they're going to retire, they're 60 or 65, whatever the case may be, they think investing is done. You know, like, okay, this is it. Now what? And they get a bit of a surprised look on their face when you say to them, well, potentially you could have another 30 years of investment ahead of you. Yep. And they don't think in those terms. They think, well, I'm at retirement, my investing's finished. No, it just means it's going to take a different form. You're going to take income as well as invest. Sure.
And the styles are different. I think that sometimes we have to look at things like the RESPs as an example, with a very defined time horizon where we're going to take the money out at age 18 and only for 4 or 5 years. It's not for, we can't tell our kids, hey, the markets have been poor the last 3 or 4 years. We're going to ask you not to go to school next year. We're really trying to make sure that we adhere to, within a very short period of time before needing the income for education, that we've lowered the risk, and it's there for that 4 or 5 or 6 years, depending on how long your child goes to school. It's there for that period of time.
Yeah, that's great. When you guys are sitting down with your clients, or even people on the phone, or people you met through golfing and all that stuff, how important is it to coach them for them to understand why they are saving money, why they are talking to you guys, why they are having this conversation? What is the development that happens with that?
You end up, as you know, trying to define what the person's goals are. So a lot of the time someone will come to us and say, well, I have this lump sum of money to invest. Well, what are you trying to do with it? Are you trying to allocate it for other investment opportunities? Is this to help with retirement planning? Is this to buy that cottage you always wanted? Is this to leave to your favorite charity? It ends up, so it becomes an exercise more in their goals as to, the reasons why they're saving.
Agreed.
And it points out the idea that you need a plan. If you're going to accomplish something or get somewhere, you need to have some sort of plan. And really, that's what we need to do with a client, is sit down and talk about what's your plan. Let's craft a plan for you to help you achieve what you want when you want.
I think sometimes it's also about making something tangible for the end. We deal in this financial world of intangibles. If we worked in a nice car lot, I'd show you a beautiful vehicle that you'd be buying and you get excited about it and you'd be like, I want that. And sometimes when we're just saving money and it's taking a good chunk out of your cash flow, it's hard to actually think about what that means and what kind of value that's going to bring to you and your family for a long period of time. So part of the skill of being good at what we do in our world is trying to address that and communicate that to someone who's a client so that they can actually start turning that into a visual. And it's like, well, what is the difference between getting to the finish line, retiring, and just simply having a pension versus retiring with a pension and maybe $250,000 in your bank account, because there is a difference and it's going to feel different. And how's that going to feel? Because certainly someone in this day and age working for the federal government or a very good professional job, they're going to retire with a nice pension. We don't have to worry, are they going to have enough to put food in the fridge? But the difference in the lifestyle choices that they can make after that point in time is significant. So just trying to have them see, if you don't do anything, this is what it looks like and feels like. If you do something, or if you make a change in your personal plan so that you can effectively take some money out and then affect those changes, here's the difference. And if you want that, if that's great, and then we'll help you with that. And sometimes I don't want it, sometimes I do, but I think you really have to start visualizing what is that difference to understand the importance of having a plan.
Yeah, good point, Sean. And sometimes the client will say, well, why am I investing? And you touched on it, choice. Do you want to have a choice? Is the vacation going to be in the backyard, or is the vacation going to be to somewhere sunny and nice and warm? Well, the difference may be choice, and that's the one thing that investment may give you, is choice.
I have no doubt that after we go through what we're just going through right now, that this is going to really start changing a lot of people's perceptions about the importance of having a plan. Because at one point, I think a lot of people would believe that I'm okay just doing what I'm doing, which may be nothing, and that I'm good. But right now we can see the importance of having a little extra dry powder and some fuel by virtue of having extra savings.
Yeah, certainly, because we've had, this period where there's been a lot of consumer spending. We've accumulated a fair amount of debt, as consumers across the board. And so now, during this period of uncertainty, it very much becomes, well, how much savings do I have? Have I put away the 3-month emergency savings plan? Do I have that available, or am I just living off of credit? Because that really starts to, you can hemorrhage quite quickly.
Agreed. Totally
true.
Yeah, no one wants to do Rice Week, that's for sure. I've been described personally as someone with a big heart, a little bit emotional on time through ups and downs and stuff like that. How do you, as you guys as advisors, wealth managers, CFPs, CELUs, how do you guys manage emotions, both good and bad?
Great question, Ben. I don't even know if we can manage, like, how do we do it ourselves or our clients? I guess there's two sides of this, because there's our own emotions as well. Like from a CFP side, helping my clients, this has been a tremendously emotional journey this past 6 weeks. And for me, it's really trying to turn off some of that emotion so I can stay analytical and, on top of things and overview my clients' situations and give them really good feedback without letting my emotions overcome what makes sense. I think for managing the client's emotional side, it's helping them to understand what the weaknesses are to our own emotions. I think sometimes we become slaves to that. They happen. We just don't realize how much they dictate our own decision making. So for part of our job is to also, guide them and explain to them in these situations, whether it's an investing situation like we have right now, where we have some turmoil in the marketplace and clients are worried and they make decisions that impact them. And we're not talking small decisions, but they can make a significant decision right now that will have a very significant outcome differential in 20 years time. So it's trying to guide them in that and recognize, you're talking to them the whole time, recognizing that this is what you're feeling. Maybe it's not talking them out of the decision, but helping them to understand why they're wanting to make that decision, and being very clear and trying to and dig through the layers so that you better understand what they're really needing. Because if they're really just needing some better education or better security, then maybe we can provide that without actually having them make a change that's going to blow them up.
And typically what happens is clients make decisions based on emotion sometimes, and for the wrong reasons. I'll give you an example. So if we're in a bull market, really the market's going gangbusters, everybody wants to invest. Everybody wants to jump on board and invest. And when the markets are doing poorly, then nobody wants to invest. Well, that's letting your emotions rule how you invest. And really, that's the wrong way to invest. What you should be doing is, when the markets are poor, that's a good time to get invested. When the markets are really good, that may be a very poor time because the price is going to be very high. And it's important to realize that you shouldn't let emotions rule how you invest or when you invest.
Yeah, that's a great point, Brian. Sorry, Corey, but one of the very first things I saw when I came into this finance world was the correlation between market performance and how much the inflows and outflows were. In a perfect world, it should be completely opposite. Yes. As the markets are increasing, clients' deposits should be going down. And then as the markets are decreasing, clients' deposits should be going up, but it's not. It's completely in lockstep. As the markets increase, clients are increasing their deposits, and as markets decrease, clients are decreasing their deposits. It's incredible. So it's a point we want to make over and over.
Well, probably, arguably, one of the most famous investors that's still alive to this day is Warren Buffett, and his saying is, "Be fearful when others are greedy, and be greedy when others are fearful." So I think it's case in point, and I think if there's enough data and history that shows that when people make behavioral type decisions with their money, they generally make poor ones because you're making them generally during times of distress or discomfort. And so we've seen through numerous corrections in history the amount of people that have exited the market during that period and how they have underperformed so much compared to what the actual index has done.
Yeah, and where we see this on a really small scale is every year in January, February, everybody jumps on the RRSP bandwagon and they're investing like crazy in RRSPs. But, that's when, because of advertising and so on, they've driven up the price over that period of time and made the returns look really good. Whereas if they dollar cost averaged through the whole year, they would have done much better than just putting a lump sum in February.
Agreed.
Totally.
That's a really good point. I wouldn't even have thought of that unless you explained it to me yourself. Sometimes just the littlest things slipped right under. Another thing that's probably happened is dealing with people's expectations and being realistic. How often do people come in with a sizable amount of money and this is going to grow times 10, times 20, or how do you guys deal with controlling that realistic output?
you end up, a lot of people will say, well, my neighbor invested in pot stocks and made 200% or Bitcoin or whatever the latest and greatest trend is. And, one of the things that we do is we actually go through and educate clients on just compounding of interest and the power that it has. And you don't need to achieve these monstrous rates of return to really, experience positive momentum in your portfolio.
True. And, one of the things to do when you're sitting down with someone is to set their expectations to something reasonable. So when we're sitting down with, for example, a moderate investor, we'll say to them, your expectation should be 4 to 6%. Now, there may be periods of time where it'll do 10 or 12%. Is that realistic? No. 4 to 6% for a moderate portfolio is more realistic. And, if you set those expectations early, then they're not going to get offside when, things go awry.
And I'd even take it one step further, Brian. Like that's a very, a high level that, we might achieve that at times, but from a planning perspective, if you refer to the Financial Planning Standards Council of Canada, that's just now referred to as FP Canada, and their guidelines, equity portfolios are in that 6% range. That would be on an average over a 10-year period, net of fees. So I think that sometimes, investors would think what you just said is they believe, well, I'm going to get 10 or 12% out of this, which might be true. They might have a really good, strong return for a period of time, which is very achievable. But I think from a planning perspective, clients should have a reasonable rate of return expectation, and then marry it up with a good investment advisor that can say, hey, this is my experience. This is how I build the portfolios. This is what I think you can achieve. And if that pairs up, that's fantastic. But I do think sometimes people come in either have been dismayed from previous advisors and being told something that's not achievable. And it takes a bit of conversation to bring them down to what really is a long-term sustainable rate of return and what is within their parameters, because it's different for everyone.
Yeah, great point again. Something that we probably have all really started to understand over the last 6 weeks, kind of like what we talked about, is understanding what you can control and what you can't control.
Yes.
How do those conversations been coming up over the past 6 weeks? I know they've probably been more difficult than normal, but talking about the control that you have and understanding how to live with it.
Well, I think from the, what you can control your, as the investor, you can control your emotions. You can control as to, do I think the world is ending? Do I think we're going to recover? Going through, those fundamentals in terms of, do we think that, we're going into an apocalypse, or do we think that, in a year from now, the world will be a better place? And I think as history has proven again and again, the world generally ends up in a better place. So I think, those are definitely things that can be controlled. And I think from the advisor side of the equation, it's making sure that the client's time horizon is in check with their risk profile and what is their goals, and maintaining those principles to get the client where they need to go is really one of the keys for control.
I think that's a really good point. And I think just shoring things up to make sure that, when you say, control, we control, someone has a choice to make. They're going to get up in the morning today and know either they have things that have been undone or not done at all, and they have a chance to change that. And it's a matter of instilling advice to them to say, here's some things we can change for you today that you can definitely control and you can fix. Whether you're underinsured, maybe you need a disability insurance policy, or you need some life insurance, or you just need to get your will done. But if you haven't done it, you can control that by virtue of making a choice and a decision to implement that strategy. And if we're talking investing timeframes and we're talking about performance, well, we can control risk. We can control risk in the portfolio. I can't control what I can't control, which is the stock market performance, but we certainly can control the measures of risk. How much risk are we willing to take on inside of the portfolio? And as long as we're educated about that, that's great. I use this example the other day when I was talking about risk, because someone was asking me, on a marketing question was, am I a risky person? And, because I'm really always trying to outthink risk. And I said, no, I think I do like risk. I don't mind. I come from a world in the past where I used to scuba dive. But I can tell you what I didn't do is I didn't just put my equipment on and jump in the water right off the side of the boat. And the first thing we did was you come up with a plan. You look at what are the risks, how much air do I have? How long am I going to be down there for? What depth am I going to? And what happens if something goes sideways? Because I need to have an exit strategy to get back to the boat safely so that something something risky does not happen. So we control risk by educating ourselves. And, if I'm in that situation, I'm controlling my risk by being educated and understanding the risk. And right now we can control the risk by certainly educating ourselves on what the risks are in the current market and educating ourselves to make good choices. And that's what we can control.
Yeah, the only thing you have control over is yourself. You don't really have control over anything else. So, worry about yourself, control what you can, and don't worry about the other things. I've had people ask me, well, what do you think is going to happen with the stock market? I tell them I don't have a crystal ball. I don't know. I don't have control over that. But you do have control over some of the decisions you make, and they are going to affect what your future's going to be.
100%. If I say this sentence to you guys, leveraging diversification, what does that mean to you guys?
I think diversification is an important thing then, insofar as, when you have a portfolio, you need to have a diversification in terms of what you're invested in. If you were all invested in oil right now, you wouldn't be a very happy person. But if you were invested in a variety of sectors and a variety of areas, then you might be very pleased with the results.
Absolutely. I think a lot of people assumed that there was a lot of pain being felt across portfolios. And I think for a well-diversified portfolio, and what does a well-diversified portfolio mean? It means not being all in one sector. It means, as Brian, alluded to, it means not having your entire portfolio in energy, or not having your entire portfolio in pot stocks. And, spreading that risk across sectors is, proven again and again that will achieve the best results and provide the best downside protection that one can have.
Yeah, totally agree. And I think it's often overlooked. And I think right now it's the biggest saving grace to many of our clients that are going through this market correction has been the diversification. And I guess some strong points you guys have made.
Yeah, and what I think a lot of investors don't realize is that when they invest in a fund, that fund has underlying funds, and those underlying funds are like onion skins, layers and layers and layers. It could be 50 to 100 different stocks or investments underneath that one fund. And as a result, that gives you protection. The old saying is don't put all your eggs in one basket. Well, by having all those layers of investment, it's going to provide a certain amount of protection. And I use the example with a client where I'll say, you may think Tim Hortons is great stock. Well, yeah, but Tim Hortons, if it goes sideways tomorrow, then you lose. But if Tim Hortons is just if it's one of 100 different stocks in that fund that you're in, who cares?
And you definitely want different positions within your portfolio working, at different times. You don't want everything moving in the same direction. An example would be, if you had Canadian banks in your portfolio, and you had, the Apples and Microsoft and Amazons in your portfolio right now. Well, there's a really good chance that your Canadian banks you would certainly be negative on right now, and on your tech and consumer side, you would be up. And so that really helps, how the pendulum swings.
Oh, of course, because there was always a best performing asset class in the fall of 2008 after the financial crisis. Like there was something was working really well there. It wasn't financials, but it was something else, right? So that's diversification definitely does help. And I think to answer questions that I often get asked is, we can go to extremes with the diversification if we have to. So if we look at the low volatility exposure funds, they accomplish that by having an extreme amount of diversification, sometimes over 144 or 150 positions inside that holding. So of course the risk is very strongly mitigated by virtue of dilution. But then if clients, on the other hand, some clients might say, well, I don't want that. I want diversification, but I want some concentration. I don't want that if we have quick shifts in the market, I don't want to be so diluted that I don't participate. And we can achieve that as well, because there are very concentrated, diversified holdings that allow us that as well. So diversification is a moving scale, and it mirrors up depending on what the client's preferences are.
Yeah, totally. Nailed it. From an investor's experience, what does it mean that one needs to accept a mistake?
Well, I can tell you, I think it means a lot. I think people sometimes didn't save enough. They didn't start their programs when they should have. They might have bought too big of a house. They haven't finished their will. They didn't start their kids' education savings until they're 14, or maybe they haven't even started them yet. And I think, so sometimes, as an investor or just somebody who's interested in yourself, you have to say, hey, I might have made a mistake here. And and right now might be a really good time for a lot of people to do some looking in and saying, you know what, maybe I shouldn't be handling this portfolio, or maybe I've made some good turns in the past. I've got 3 or 4 positions which have done very well, but I've got 5 or 6 that have not done well. And I want to make sure that I put myself and my family in a better spot in 10 years. So now would be a really good time to start looking at, are you happy with, have you held yourself accountable? Do you like your results? And if you don't, what are you going to do to make those different, to change that?
Yes, and I think that it's, we all, no matter who or what we are, we all make mistakes. And some of the most successful people in the world have made the most mistakes. The old saying, falling down is part of life and getting back up is living, right? So it's, there's nothing wrong, with making that mistake. When it comes to investments, it can be a little bit more, catching that so-called falling knife maybe, or, not being able to swallow that jagged pill that you might need to let go of an investment that you bought that didn't work out. But at the end of the day, again and again, if you can just let go of that, accept that the mistake was made, pivot and move forward, that's, generally the best option.
And I think the biggest lesson that I learned was when I was working in the Toronto market, I had an opportunity to meet a ton of people who had done very, very well. They were what we would call rich. They were millionaires. They had been very successful in their life. But when you have an opportunity to talk to them about how they got there, you found in most cases they went bankrupt at some point, or they lost it all several times. And now, yes, they're successful, but at one time or another, they were on slim ice. They were, they were not doing well or had lost everything. So, people do make mistakes, and sometimes that's the opportunity for them to grow, and sometimes that's the stepping stone for them to come up with the success in the future.
Yep, good point.
100%. So we kind of talked about this one a little bit about the analogy of the car pulling over. If you look at the map or you trust your instincts, how important is it to know when to ask for help, especially in a financial outcome?
I think it's extremely important. I think if you don't do that, and you're uncertain, you may put yourself in a worse position. You know, it's that was a good analogy with the map. It's like being lost. If you're lost and you don't know where you are, there's never a better time to admit you don't know where you are than that particular moment. Because if you keep walking in the wrong direction, you're going to end up more lost, and potentially no one will find you. So I think, you know, if you're making financial changes or you just don't know what to do, and you feel you've made a mistake, now's a great time just to say. And there's so many great people you can ask. Like it, you know, we're doing this obviously to garnish some conversation, and we'd love to help you, of course, but there are so many great professionals that you can just lean on and ask for financial help. So I don't think there's any shortage of someone who would answer a question for you right now.
Yeah, and I think it's important to understand that even us as a financial planning firm, we need to reach out and ask for help occasionally as well. And that's why we work with your advisors. That's why we work with your lawyers, your accountants, and we have people that we work with and associate with that we can bring in to add value to the work we're doing for you as a client.
For sure. I think that's very good piece of advice, Brian. And I think comes back to, you know, arguably, well, maybe it's time to buy that compass. Maybe it's time to save up some money to afford that compass. Yes. So you can figure out where you need to go, right? And I think it's that point, you know, as we've gone through this period of time where people are challenged in their portfolios, they're challenged in their savings. It's, you know, it's okay to ask. Where, you know, there's, as Sean said, there are so many people, you know, within everyone's circle that are a phone call, an email, a text away to help guide you, you know, to reach those goals.
Yeah, agreed. Really good point.
And we're so lucky to live in this time where there's so many online resources that you can reach out to, you can look onto as well. I'm sure you guys, I'm going to ask the people on live real quick. If you guys have any questions, feel free to type them on the bottom. We're almost wrapping up here. Have you guys seen any online resources? I know Preet Banerjee has been awesome with his videos and his calculators. Have you guys seen any other online resources that you think could help people out right now?
Well, the government's putting out lots of sources of information with programs and different things to help them through these difficult times. And I would encourage people to have a look, go on their website, have a look at what programs are available to help them out. You know, don't be so proud that you can't ask for help.
Yeah, the federal government has done a great job. Their web page is updated pretty much daily on the programs that are available for people going through. Obviously, we're all going through it, but the programs that they've massaged for the COVID crisis, I think it's a great resource. Preet Banerjee has done an amazing job as well. Those are two of my first go-tos when someone's asking me, hey, I need some information. You know, where should I look?
Yeah, I think the resources are fairly endless, you know, in terms of what is available. You know, great shout out to Preet for sure. You know, there's lots of media personalities to follow out there, the Kelly Keens of the world. Rob Carrick's, you know, is a familiar name. There's always lots of good insight there for the most part. So, you know, I think it's just a Google away to help you, you know, on that path.
Yeah, that's a good point, Craig, too, because we just had Kelly on our podcast, and she just finished her book, and she's published this new book, Talk Money to Me, and it's a great start for anyone who's interested in improving their cash flow, improving their emergency savings, maybe just digging out of that hole one last time so that they can actually have a good financial future. It was very interesting. That book is on sale right now. I just ordered some copies and sent them out. So it's on sale. You can get it on Amazon. It's very affordable. So Talk Money to Me, Kelly Keene. If someone who right now is listening and thinking, you know what, I really want to learn more. I don't know enough about, the government investment programs or just improving my credit. It might be a great start.
And it costs nothing to talk to us. So we're always
excellent point.
Call, email, an instant message away. Do not be shy to reach out. There's no stupid question.
There's not. No, not at all.
Perfect. And to Sean's point, I read Talk Money to Me, and the amount of knowledge that I learned as a rookie learning in this industry and stuff like that was phenomenal. I think I came out of it with about 15 questions. I looked at myself and said, I need to start doing this because of this, of what I've read through the book. So that was pretty awesome.
I think you just said too, Ben, you told me you found it interesting to learn how much raising a child costs. Is that right? Is that what you, yeah.
I wouldn't say it made me throw up in my mouth a little bit, but I did not know at all that they would cost that much money, or even what a mortgage burning party was. That for something like that, my age demographic, I'm 30. I know I look a little older, but we don't know about these things. No one talks to them about it. So looking through that book and realizing, I don't know the exact number off my head, but it was astonishing to me.
Yep.
Perfect. Looks like we're going to be wrapping up here pretty soon. Do you guys have any final statements? I know the Mind and Money Show is always good to listen to if you're looking for a resource, so don't forget about that. But does anyone else have anything else to say?
Yeah, I just want to make sure we have so many ways to connect. And I just, I know we're going to be streaming this out on our Facebook right now. I know we have some viewers and LinkedIn. But we've also got a dedicated page on YouTube. So Acivda Financial has a dedicated YouTube page where you can see not just this video, but all the previous videos we've done before with all the Q&As that we've done so far. We've done one every week for the past 6 weeks. We also have, as Ben mentioned, our Mind and Money Show podcast, which has, an assortment of podcasts from people who are interested in topics on improving yourself, improving your financial position. Also geared for entrepreneurial people who want to listen to business owners talking about success and things that they did to improve themselves in this world. We've got a Twitter page, Facebook page, Instagram page. So all of those, great way to connect. If you're sitting at home right now and you want to connect with us, we've got lots of stuff we can stream out to you by virtue of those connections.
And keep in mind that just because we're not in the office physically, we can still reach out, do virtual meetings, all that we did before, we can do now. We're not handicapped in any way with respect to doing business, talking to you, having a meeting with you to help you.
Corey, any final statements?
Just would echo both what Sean and Brian said. Follow us, like us, reach out. We'd love to talk.
Perfect. Thank you to everyone that has joined us today. We've been doing this every once or every 2 weeks. We're looking forward to speaking with you guys and hearing from you.
Thanks so much, everybody.
Thanks,
Have a
everyone.
great day.